Good afternoon, ladies and gentlemen. Peak Capital has completed its recommendation for Viking management regarding the acquisition of the Bancorp Centre in Minneapolis. My name is Edward, this is Alex, Nigel, Angus and Caroline, and today we will present a strategy that executes the acquisition within 1 month and delivers a higher IRR to both your shareholders and to a private equity partner. The Bancorp Centre is a Class A asset located in Minneapolis with gold lead rating and a high energy star, making it an attractive acquisition target as a building. Now, we believe that our strategy can yield an IRR for Viking of 27% and 23% for a private equity partner. Now, moving on to our acquisition strategy for the building. We consider the building to be presently worth $175.5 million based on 3 factors. The first is our intrinsic valuation. The second is market comparables of recent transactions in Minneapolis of Class A towers. And the third is the timing of the deal. The FTF board has indicated that they want this asset off their books by Christmas this year, which means that they don't want it to go to a broad market tender, but would rather have a rifle shot approach targeting a couple of bidders, such as yourselves. So we believe that this acquisition price will see the deal come across smoothly without broad market attention, but still at a fair price, satisfying the needs of FTF. Now, moving on to possible partners for this deal. It is our opinion that a private equity real estate firm would be the optimal partner, given the capital agility of these firms and the risk-return matrix that they expect. However, this is essentially a relationship-driven process. If Viking management has any other, say, high net worth individuals that they could approach, or a smaller, more agile REIT that could still get this deal done within a month, then that would also be an equally opportunistic partner. However, given the facts in front of us, we believe that a private equity firm is the best option at this point in time. Now I'll hand over to Angus to run through the Minneapolis market dynamics.
Thanks, Ed. So the office building is positioned in Minneapolis, which is a strong secondary market with solid macroeconomic fundamentals and a positive growth outlook. So the city is home to 17 Fortune 500 companies, which ensures sustained demand for employment, as well as a lower median age and a higher level of education. So it's important to consider where the property is. It's surrounded by a number of other financial and insurance firms. This will retain significance for the current tenant, as well as position it well for a further tenancy mix. Population growth in Minneapolis is expected to exceed US averages, and this will sustain demand for commercial office space. We looked at a number of commercial property indicators as well, and these figures paint a very solid picture that our ownership strategy is the only strategy that will yield decent returns. We can automatically dismiss residential and hotel conversion due to exceptional levels of supply in the pipeline, which will increase vacancy rates and cripple capital values. Retail, we also don't believe that this is a viable option due to the positioning of the block being undesirable for retail tenants. However, we do note that retail tenants can benefit an office block, so we will look into that as well. Office market's performing well with significant rental growth, a continuing trend in the decline of vacancy, as well as a limit of supply in the pipeline. So this is certainly the highest and best use of the block. With regards to the asset itself, the short term of the lease provides us with extensive value-add growth opportunities. So what we want to capitalise on is 3 key points. Significant lease-up in which we work with Bancorp to retain them as an anchor tenant. And to do so, we want to build and develop relationships with them to provide office accommodation that is suitable and desirable to their tenancy. We'll do so by employing value-add capital expenditure and capitalising on market trends, such as open plan accommodation, breakout space, rooftop terraces, cafes, and the like. We will target an optimal exit value once our income is stabilised and our WALE, or weighted average lease expiry, has extended to its optimal point, which we believe will be in year 5. So in order to do so, we will propose a 5th lease option to USB, which is a 10-year lease, paying 100% market rent. However, this is incentivised by 10% of tenant improvement packages over the term of the lease. The 620,000 square feet of net lettable area is customised specifically for the tenant. So we believe that this is the optimal tenancy for them as well as for Viking. So we believe it is imperative that Viking propose this in order to maximise the value of the asset. So I'll hand over to Caroline, who will explain this in more detail.
Thanks, Angus. So we really have a 5-phase strategy for the overall IRR gains on this property. So we start in, obviously pending our due diligence, we expect by December 16 to have closed the purchase. And then we have a 2-year period in which we can start to build a working and positive relationship with our anchor tenant, USB. And this time we expect to be able to find what they want out of the building, what we need out of the building, and to come to a harmonious understanding. So in 2018, that brings us to the lease decision, at which point we believe we'll have the favourable lease arranged. And then we can begin a 3-year CapEx strategy. So in this time, we suggest that we will replace the roofs, which we know needs to be done in the building, but also extend out the floor 15 rec space onto the roof to create this outdoor multi-use area. Also helping with the millennial vibe of the building. At this point in time, the custom lease would see the anchor tenant move into floors 10 and above, and we'd see floor 9 in dark blue here become a flexi space. So at this particular arrangement, we would see USB potentially letting out, or subletting rather, this space in order to customise what they need. It is for a strategic reason that we've left the bottom floors empty, and that's to do with the mitigation of the valuation participation fee. And this we expect would save about $4 million compared to having to pay the valuation. We then have one last year of CapEx, but we also see our lease-up strategy take place. We'd expect to see a financial services firm move into the pink floors, maybe Piper Jeffray, an insurance company, we're not sure yet. And also then on the ground floor, we'd see some service retail move in, and retail specifically designed to service the needs of this building. Obviously then the sale period in December 21, with 100% of the building occupied. This is just a current look at what the floor plan is in Tower A, the tall tower. As you can see, it's a very 2000s design. It's very cramped, it's claustrophobic, and this is what we have in mind for the area, again, floor 26. This not only meets USB's needs rather, as they shift to open plan office designs, which they've indicated that they're interested in doing, but it also meets the market needs, which helps with our resale strategy at the end of the period. This is a potential fit out of what this collaborative area may look like. So just briefly on our exit strategy, this becomes a very solid investment for an insurance firm or a pension fund. We add approximately 4 to 5 years on the WALE of the building. We see 100% occupancy. We have a very low number of tenants relative to the size of the building, and we see a significant portion of the building letted out on a triple net basis, which is very positive, and altogether this feeds into our $220 million sale price for the asset. Alex will run through our finances.
So obviously having the 5th largest bank in the US as a tenant is a great thing, no less having their headquarters there. But let's take a more minute look at what USB actually, how they are performing financially. They've exhibited strong and stable loan growth over the past 5 years or so, growing at a 4.4% cumulative annual growth rate. This has translated into relatively stable increases in their net interest income, albeit with some compression in their net interest margin due to the low interest rate environment currently. Now, what about their demands for office space? What about their employee numbers? We can see that last year, employee numbers actually contracted. However, this was highly correlated and actually associated with the closure of a number of branches as well. So we don't think that this will impact any of our back or front office workers that will inhabit this building. So there's no worries about USB as a tenant as a going concern. So in terms of the deal financing, we had 4 options in front of us, and we decided to rule out 2 of those immediately. And that is the Wells Fargo bank loan and the Square Mile Capital debt fund. And this is because both would see covenants outlined in the term sheet specifically relating to the debt yield violated in 2021 during our letting up period, which would trigger a full cash sweep for some portion of the year until 85% leasing was achieved. Now, this is not optimal at all for equity holders, so we've ruled those two out. And we've gone with either the City CMBS option, which may actually be hard to obtain, and the FTF seller financing option, which is our number one preference for a number of reasons. We have a 1 percentage point increase in internal rate of return above the City CMBS. It might help grease the wheels a little bit when it comes to the transaction, given that FTF have outlined that they want to hold this senior debt as a piece of paper, get some income from it. And also, just generally, the loan terms are very good. So moving on to our full capital stack, we've got a 70-30 debt to equity split. Now, as I said, the majority of the senior debt will be funded by the FTF seller financing, which will maximise or use to its full LTV of 55% of the transaction value. And of course, we've got our 30% private equity contribution, 30% equity contribution, 90% of which will be private equity contributed, and 10% of which will be contributed by Viking, consistent with your investment strategy. Now, the remaining 15% will be funded by a mezzanine debt loan with a 5-year interest-only period, just protecting those cash flows from any sort of debt servicing covenant breaches. And also an assignment of a partnership interest, so there's no lien on the property, which may have actually scared off some of the senior lenders in that regard. So overall, we'll see that these cost of debts and cost of equities will arrive at a 9.7% weighted average cost of capital for the project. So in terms of our assumptions behind some of our valuations, we've been very, very conservative here, and we have not relied at all on any cap rate compression to generate returns, simply our value add and lease up strategies. We can see that the average of the Minneapolis historical and forecast average cap rates is around 7.5%, which is right on the money for our assumption there. And we can see that, as Angus mentioned, office rents are growing at around 8% per annum. And we've got 2% average inflation over the past 15 years or so in Minneapolis. Therefore, our market rental growth assumption of 1% is very, very conservative, and the risk is severely skewed to the upside here. I'll now pass on to Nigel to talk about the more qualitative aspects of this risk analysis.
So thanks, Alex. One of the key features of this project is its relatively low and manageable risk compared to its high and strong returns. So as you can see here, the risks generally take place in a region of relative safety. So what we've done is broken the project down into key value drivers and targeted our mitigation strategy on these value drivers. So the ones worth note are obviously the value of the underlying lease agreement, the ability to get a favourable outcome on the true highest bidder requirement, and also that 2021 exit point, which is brought on by our 2020 exit strategy. So all we'll basically do is start formal arrangements or meetings with USB to tease out the underlying concerns and interests and ensure that we understand where they stand. So what we'll also do is conduct due diligence into the legal matters of the full lease arrangement, the current trust document that establishes FTF, and also the zoning ordinances for the Nicollet Mall area. So what we'll aim to do is leverage the findings from the due diligence and the relationship to mount the most compelling offer to USB, because essentially we can never really take away the risk that they decide not to renew. It's a sunk cost. But with our strategy, we look into the current lease deficiencies, we leverage a relationship, and we make sure the offer is the most compelling they can find in the Minneapolis city. And this is a city they've been for almost 150 years. So essentially, we've pinpointed a very, very low risk, we've doubled down on it, we've consolidated our value drivers and protected the project's overall returns and value. I'll now pass you over to Ed, who will discuss the bull and bear case.
Thank you, Nigel. So for our bear case, we've shocked the capital expenditure, turning it up over the our very conservative values. We've decreased the rent, and we've increased the cap rate by 0.5%, which is a situation that we believe is entirely unlikely. However, this still delivers 11% IRR, which is over the WACC for the project. Our bull case, which we believe is far more likely, delivers a 36% IRR. Now, this is with a 5% cap rate softening, which we believe is quite possible, considering that the Minneapolis market is strengthening and considering our own lease up and our capital expenditure. So in summary, we believe that this is the optimal strategy for this asset for a number of reasons. First, the favourable acquisition strategy and price. Second, the achievable value add strategy we'll push through will attract private equity interest in this building and add value towards our exit point in 21. And third, the attractive returns given the low and manageable level of risk. We thank you very much for listening and we look forward to your questions.
Okay, I guess we can start the questioning.
Can you just go back a little? You said that you were going to leave the bottom floors free in order to dampen the valuation so that you don't have to share it in any participation with USB. Is that what? Yeah.
Yeah, so...
Just go through that for a quick second.
Yeah, absolutely. So one of our concerns was paying a 35% participation fee over the revaluation to USB. So that valuation occurs in 2020, and then once that's been valued, then that participation fee doesn't occur again. So it won't occur at our point of sale. So what we wanted to do was we staggered our capital expenditure. So once we'd moved USB up into the higher levels of the office space, we still want to add value to the lower levels and reconfigure that space to attract tenants. So we'd already been in discussions with tenants for those bottom areas, but having a property that's half full, under construction in the bottom levels, that'll push out the valuer's capitalisation rate, and then with the added the further capex that we'll have to spend being deducted from their valuation, we don't believe that participation will have to be paid. So that's sort of how we got around that issue.
Can we see your cash flows? I'm trying to figure out how you're getting to a 27% deal IRR.
Sure. Alex.
Bring back square mile.
Sure, so for Viking, we do have a high return figure for you guys, especially because you are paid that promote fee. The way that promote fee is structured is that for every dollar you earn above a 20% IRR on the project, you will receive 10 cents. So you're getting 10 cents for every dollar you earn over that incremental IRR, which we assume would be a very safe benchmark for a private equity partner. So of course, Viking is going to have to invest 10% of the equity stake, with the private equity investing the further 90%. And you do see that over the life of the asset, the cash flows are very stable simply because for the remainder of the lease, we do still maintain that very stable triple net lease cash flows that we receive, that FTF is currently receiving from the asset. It's only until 2020 and 2021 when it starts to become a little bit more different following our capital expenditure programs and also the letting up period of the building, which we do for conservatism and also to avoid the revaluation fee, which would save around 4.3 million. So that's how we arrived at our cash flows for Viking in terms of the equity cash flows. And obviously your private equity partner will receive the remainder of those cash flows from the property.
The $6 million over 3 years, each year for 3 years, is that for US Bancorp?
Yes, that is for our capital expenditures for US Bancorp.
Yeah.
So they're going to go through a 3-year renovation program while they're in the building?
That's not all for them. So hopefully by the second year, then the $6 million will be for incentivising other tenants in. So we know at the moment they've got levels that are vacant as well. So we do have space to relocate these tenants, and that's all sort of part of that first 2 years initial due diligence is working with them to build the best strategy. So one of our points that we'll have to address during those initial discussions will be how best to accommodate them through that. But yes, in essence.
Do you have a breakdown showing what is capital expenditures going into the building for some of the renovations? What's TI, what's leasing commissions, what's annual reserves for general maintenance?
Yeah, so...
Do you have years on that? What years are you talking about?
So this is basically just a general capital expenditure breakdown, which breaks it down on a per square foot basis. So retail will be a fair bit more development costs because our costs for the office space are fairly minimal. There's not a lot of construction going on. It's predominantly internal demolition. And we've based these off CBRE's construction guide for Minneapolis. So I don't think we have a breakdown of what's capital expenditure versus TI, but it's about a 12 million TI and then $6 million of capital expenditure for the lower 7 floors.
And what about the roof you talked about, and build out public space?
Yeah, so that roof will, so the build out of the public space comes into the TI. So under the current lease, USB are responsible for all their capital expenditure. So what we want to do is not pay for all of it, but incentivise them by giving them these 10% tenant improvement packages.
Would you come up with 19 bucks a foot?
That was based off the CBRE's Minneapolis guide, and originally it was $55, it said, for new construction. So we've adopted that down for internal demolition, and then also checked for other internal demolition costs based off a rough guide, but we'd probably need a technical due diligence on that figure.
Didn't you say up front you were using 10% of their rent as their TI?
Yes, but that would equate to about $12 million, but then this figure incorporates all of our capex that we're looking to spend over the life of the property.
What if US Bancorp doesn't like your lease structure?
Well, that's obviously a very real possibility, something that Nigel touched on. But we have looked at what they're currently doing, which is that the floor space, looked at sort of market TI packages as well. And what we want to do is we don't have to have this perfect before that 2-year period, so we want to accommodate them by developing this relationship and building that relationship with them. So if they opt for one of the other lease options, then that's up to them. But we believe that it's tailor-made to them, and that's the way the market's heading. So it's heading towards.
But what if they choose a lease option that's not in your building?
Well, we've looked into the market, and there's no supply for them. So there's about 172,000 square feet vacant. They're going to need at least 620,000 square feet based off 151 feet per person, and then there's not that much supply in the pipeline to accommodate them either. So if they want to remain on their whole security point as well, they're not going to spread across 5 separate buildings to accommodate this. So, but again, what we want to do is build the most compelling offer that they'll receive in Minneapolis, and we believe that this is it.
What's your strategy to approach the seller, and how do you position yourself to buy it and buy it at this price?
So we believe that with our improvements, this will become a very high class, very low risk asset with stable cash flows going on for around 10 years. So, Seller, yeah. Yeah, so by the time we come around to selling this asset in 21...
We approach the seller.
We approach the seller.
How do we buy it?
Is the current seller FDF?
Oh, the current seller. Oh, I beg your pardon. So approaching the current seller, at this stage, they are very keen to get this asset off their books. So we already have contact with their agent. Well, Viking already has contact with their agent saying they're keen to get it off their books by Christmas of this year. But they also, being a charity trust, they're accountable to their trust holders. So they need to have a decent return on this asset, and they don't want to sell this asset for less than market value. So we believe that by putting forward our fair price of $175.5 million will satisfy kind of the mix between hitting that price they want and also getting it over the line in time. Now, they are keen to get it off their books, as I've said. So by going a bit lower, initially they said $200 million, but obviously that's quite overpriced given intrinsic valuation and market comparables. But $175 million, we believe, is very reasonable, and we'll see it over the line within the time frame that we've slated today.
Just briefly on that also, as Alex mentioned earlier, taking up their offer for with FTF's paper offer, we do think that that will help sort of smooth the process and, as Alex mentioned, grease the gears of the deal in those early days. So we think together, with the reasonable offer and the sweeteners along the way, we think that they will be quite amenable to our suggestions.
Can you just talk about the financing for a moment? You suggested FTF's going to provide the financing. Did I understand that correctly?
Yep.
Yes.
Yep.
So what if they don't?
If they don't,
How does that affect your IRRs?
yeah, sure. So if they don't, we would be forced to, out of these 4 options, of course, we would be forced to go with the city commercial mortgage-backed security. That would dampen our IRR by about 1 percentage point. So overall project IRR will be about 22%. So your private equity partner will receive 22% and Viking probably around 26%. So there's not a lot of material difference between those two there. It's more just we chose FTF because of that higher percentage point, and also, as we've reiterated, to get the wheels spinning, so to speak, and make sure that FTF do actually have some income from this property afterwards.
And you've suggested there's mezzanine financing that's going to go on
Correct.
top of that, and thoughts on who's going to do that for 8% besides square mile? Square mile.
Sure. So the 8% is a little bit optimistic, but mezzanine debt rates have been hovering between 6.7% and probably around 12% recently in 2016. We think given the quality of the property and also the stable cash flows that it currently generates and will generate after our strategy, we think that a mezzanine financier would be pretty happy with that. Of course, the mezzanine financier will be brought in, we assume, using the contacts of the current private equity partner, who we do assume would be very familiar with a lot of mezzanine financing firms, given that they usually rely on mezzanine financing to increase the agility of...
So the thoughts are, go to the equity partner first, they have a relationship with somebody that provides mezzanine financing and have them bring that mezzanine.
Yes, that's the idea. And it's actually...
Is the belief that if you went to FTF, they're going to be happy with mezzanine debt?
Yeah, I mean, I think they would be happy with it, given it ensures that we can actually purchase the property. Private equity generally has a maximum equity commitment of around 25 to 30% of the property value, just ballpark figure. So we think that if we didn't have this private equity partner, the transaction would not get done in the month that we need to actually...
Let's talk about that.
Sure.
They're under time pressure to sell.
Yes.
You have a structure where you burden them with putting a loan agreement together. That takes time. They have to think through that. Now they have to come into an intercreditor agreement with a mezzanine debt provider while you're negotiating on the equity with your jet. Seems like an awful lot when they really want to sell this quickly.
That's true. I think most of the delay would come from the interfacing with FTF. But again, I think that the mezzanine financing and the private equity partner would not be much of a worry, given that they're used to capitalising on opportunities that might be gone.
I mean, are they sophisticated enough to even know what mezzanine debt means and an intercreditor and what this mortgage would look like and how to price it out?
If they're offering us senior debt, we would assume that they're quite a sophisticated investor. In terms of the debt terms, this is the term sheet we've been given. Obviously, more due diligence will be required around that, but they have expressed immense interest in holding the paper.
And what's the unleveraged return of the deal?
The unleveraged return, we don't actually have a figure. We thought that given that the deal relies on 70% of debt, that would be largely irrelevant.
And what would happen in your mind in a financing where
Sure.
a tenant could leave?
I mean, that's always a risk. In terms of which tenant would you, just like any, like the retail or the...
What if the building became empty?
Yeah.
What's your thoughts in terms of financing?
In terms of purchasing the building, an empty building?
So just walk through, you've suggested US Bank, you're going to approach them. Why don't we just back it up? So you're going to approach them. When do you think you're going to approach them? And how are you going to convince them that 620 is the right number? And then if you're wrong, how do you think through that's going to impact your ability to negotiate a good deal with your equity investor and then your mezz lender? Complicated question, I guess. But
So I guess not taking the financing side of the question, but the need, as it were, of USB to stay in this building. As we've mentioned previously, there's not many other options for a firm of this size in Minneapolis. In fact, if we looked at the pipeline, what's coming through, they'd likely have to spread over 2 or 3 or 4 buildings in order to rehouse all their stuff. So first and foremost, it is quite unlikely that they would completely leave the building. Then answering your question about how did we get to the 620 figure, really that has a lot of flexibility around it. Part of our strategy is that we do have that long time period to negotiate just how much floor space they will need. We have used just an industry sort of 151 per worker at this stage, get to 620, plus that allowance for the 9th floor. Again, it's got that flexibility. In terms of the financing, I think Alex will have to take you through that. To reiterate, we don't see a huge likelihood that they would be leaving that building, particularly when one of their top priorities is security, and being over 5 buildings is just not a secure or a cost-effective option for USB.
I mean, in terms of the financing, probably if USB was to be the sole lessee of the building, you would probably, let's say they continue their current lease agreement verbatim, we would probably still exhibit a project IRR of around 16 to 18%. That's not including CapEx or any sort of escalation in USB's rent to fair market values. So I think in that case, it wouldn't be ideal, obviously. Obviously, the strategy we have proposed today with Project Orca is the best and only strategy to extract the quantum of these returns. However, in that event, we would have no problem actually selling the building after we've locked in that longer WALE with that tenant. It's still triple net lease. It's still got a very reputable tenant in there, and we don't see them disappearing anytime soon.
If I can touch on that as well, so both those points. The market trend is to consolidate all of your employees in one building. So we've seen that in the market with Wells Fargo. They've just spent about $300 million developing brand new office space in Minneapolis. So the general market consensus is that people are seeking, the security of the one building, as well as the synergies that come and the corporate culture that comes with everyone in the one building. So having a tenant that size leave with nowhere else to go, we see is very unlikely. We actually foresee them combining their second office building when their lease expires in 2019. We've got a minimal amount of tenants, about 100 people in that office building, but we think that providing floor space for them as well will attract them to that building. So that's basically what we're planning to do, is to capitalise on market trends and make it effective. So if USB were to leave, there's a couple of other financial firms that we would look to target as well.
Can you just touch on the rent that so you've got 8.2% rental growth. Can you go back to the bull bear picture? It's so cute. So the market, just $40 that's what we're suggesting from your research, is that's the market rent for the office space.
Gross, yeah.
And that's assuming growing at 8%, and then that's the base case when you release it 5 years from now, or?
That 8% figures year on year, 2015 to 16. So
the $40 average rent, is that start in 5 years from now when you do the releasing?
That's just based on, we've started with the fair market value rent, which we assumed was $15 in 2000. We've applied our conservative market growth assumption and compounded that to current day 2016 terms, and then we compounded again into the future to get a fair market rent of around $18.30, which they'll be paying in the base case. And obviously you have that plus the 15.5 OPEX and tax per square foot implications there. So that would arrive at around a $40.5 per square foot fair market rent in gross terms. So we've actually been very conservative, and our growth rate of 1% is nowhere near the current year-on-year growth rate of around 8%.
Yeah, so I think touching on the conservatism of it, Wells Fargo understands brand new building, purpose built for them, but they're paying, I think, $29 or $35 triple net a square foot. So obviously having $40 gross is very conservative.
Is 23 the right number to win the day? I mean, you're trying to thread the needle, pay the highest, it's an off-market deal. What do you think about that? Is 23 too much, too little? How do you arrive at that?
So obviously we got to the 23 through the cash flows back to the equity holders. But in terms of the question about how it fits given the level of risk and how it fits given the private equity partner and whether it's worth it for this project, we believe that this is a fair representation of the risk we're taking on and of the CapEx we're putting through to get this building leased up and then sold into the future. In terms of the private equity partner in particular, we think it hits their 20 to 30% range. We would be expecting them to demand for a non-core market such as Minneapolis. I mean, this asset to me is, if with our leasing strategy, is highly likely and low risk. So it could, sell to another.
Well, the reason I asked you about unleveraged returns, because when you add leverage, you can make these numbers look like anything. So the basic starting point is unleveraged, because that's a pure analysis. So some competitor may want more leverage, some may want less leverage, and then returns deviate based on that.
Okay.
So 23 seems, if you believe all your assumptions, and it's all assumption-based, you're actually not articulating a risky proposition because you think the tenant's going to stay with enormous likelihood. Yeah, they give back a lot of space, but in the world of risk, that doesn't seem that crazy, right? You give back a little space. So if you really believe that, I don't know, 23% seems pretty high to me.
Yeah, well, our opinion with the 23% was, compared to some other transactions we looked at, and it's also a very time constrained as well. I mean, to get the private equity partner straight in this time frame, we are going to need to see higher returns. And it is high, but this asset at the moment, we are creating a lot of value. We're putting through capital improvements, which will help drive up the rent. We're also getting some new tenants in, and we're fitting in USB's needs to a much better level. And then we're selling with about 9 years left on the lease. So we think that although it does seem high for a non-core market, given the circumstances, this is a more than fair return for your shareholders and for the private equity shareholders.
Okay, so this is peak capital. Judges, peak capital. Steve.
Thank you.
Thank you very much.